Hello and welcome to CEO Night on the topic of raising money and what happens next. I'm joined by three fantastic panelists: Alex Lutskiy, founder and CEO of Innovecs; Shaun, Khubchandani, the managing director of Siguler Guff; and Karl Robb, the co-founder of EPAM Technology. I'm your moderator, Laurie, and we'll start with each of us, starting with you, Shaun, if that's all right. Could you just introduce yourselves for a minute to the audience tonight?
Sure. My name is Shaun Khubchandani. I'm a managing director at Siguler Guff. Siguler Guff is a $15 billion asset manager with a very large presence in the emerging markets. We've been investing across the emerging markets since 1995 and today have about $5 billion of assets under management in the region. We're headquartered in New York with offices globally. And I'm very honored and it's a pleasure to be sitting with Karl and Alex, who are both sort of stalwarts in the tech industry.
Brilliant. And Karl, would you please do the same?
Yeah, hi. So I'm a retired executive of EPAM. I was one of 4 or 5 key people who started the companies back 20 years ago, which became what you all know today. I'm on the board of EPAM. I'm also on the board of Ajax Systems, which is in a different industry, but it's Ukrainian and it's a fantastic company. I'm on 2 of the boards as well, but I suppose most people in Ukraine and technology know me because of EPAM, because of its huge financial and size success. That's it.
Thanks, Karl. And Alex, if you wouldn't mind also introducing yourself.
Yes, hi everyone. My name is Alex Lutskiy. I'm the founder and CEO of Innovecs. Innovecs is the global IT outsourcing company. We have been established in 2012, grew up from 0 to almost 800 people in 9 years, and mainly focusing on 3 major business verticals: supply chain and logistics, fintech, healthcare, and gaming entertainment.
Brilliant. Thank you. So I think everybody here will have a very different and unique perspective on the subject of raising money. Karl, you've been a serial entrepreneur over the past 30 years. Does it seem to you that, or did it seem to you that raising money from investors would be easy on your journey?
Well, I think serial might be a bit of an exaggeration. I've done it 3 times, but the first time we didn't raise any money at all. The second time I found raising money very challenging. I didn't understand it myself. And it was at a time when we just passed through the dot-com crash. And it actually was very, very difficult. The third time, it wasn't so difficult. But since I retired from EPAM, I'm working as a due diligence consultant. So I'm involved in money raising, but as a consultant, typically to investors, companies similar to Shaun's company, who pay me to do due diligence into the founders and operations of investment targets. And I would say that in today's economic environment, it's substantially easier than it's ever been, partially maybe because I actually feel more comfortable with something. But I do really see that it's a substantially easier business today to raise money than it has been in my 39 years of experience, I would say.
Okay. And Shaun, from your side of the fence as an investor, do you think that there are sort of preconceptions on raising money? Do you agree that it's a little bit seems at least a little bit easier today? And what sort of things do you look for in a business that allow you to sort of say, actually, this is a business that could some raising some capital would benefit?
Yeah, sure. Taking your first question, I think Karl makes a really good point. The access to capital has never been easier. I think this is a function of having 10 years of very low or zero interest rates. And as a result of that, the proliferation of the number of companies that have sort of popped up in the last couple of years, and they're raising larger rounds has increased. So as an investor, our job is ever harder, and the desire and the need to be selective with companies has also increased, as has competition. So to come to your question around selection and sort of what are our key criteria when picking companies. Look, it's all for us. It's all about the founders. Investing in the emerging markets, you usually are heavily reliant on the quality of the management team to drive and steer the business. So, as a longstanding investor in the region, we're never in situations where we're cashing out management teams. We're usually focused on backing management teams which have a very sizable stake in the business. And then, absent that, we're looking for businesses that are usually market leaders or sector or regional champions. So we've had our most success backing usually number one or number two in the market. We look at total addressable market sizes and we follow secular trends. So by virtue of those few key criteria, we've been able to be very nimble in markets such as Russia, all across the Eastern Europe, India, China, and increasingly Latin America as well. But again, if you ask me to gun to head pick one criteria, it's really the quality of the gentleman or lady sitting across the table from us negotiating a term sheet.
Yeah, no, very cool. And Alex, as a founder yourself and a CEO, you must sort of have some aspirations or assumptions as to what an investor would bring to a business. And have you thought a little bit about the pros and cons of raising money and what that means as a founder and CEO? You might be muted, Alex.
I'm sorry, I'm back.
That's all right.
No, I think there's definitely, as a company, as a founder CEO of this company, we don't rely that we're going to bring someone from outside who's going to drive business for us. Because I know there's some company the expectation that there's a external investor comes in and they're going to help you to be successful. So we still rely that the main success will come from the management team of the company. I guess what we expect from any potential outside investor, it's either a private equity or VC. Definitely one, which is the key factor for us as a company today, scalability. For example, we talk about the Innovecs in the service business, which is a big, we call it a red ocean. And the only way to succeed here is you have to be faster than your competitor. And so definitely raising the money for us will be the one factor to scale a bit faster than our competition, mainly because our scale based on the talent that we provide as a service to our clients. One of the instruments that we can grow is the M&A. And to do M&A, right, we need to raise money because we cannot do M&A from the operating profit. We need to raise money to really go faster and merge company that actually looking forward to be merged. So that's one, I would say, key factor that we would consider to raise money. The second one, I would say, gain more credibility, because once we get a bigger company, we go against bigger clients, your credibility, people that sit on your board also become a key to your success. And of course, the last thing is what I call saving time on making mistakes. Because if we bring the smart money, we bring the people that really have done this in the past, they will definitely help us to save not money, but save time to make less, not to make any mistake, but definitely save time to make mistakes and move a little bit faster in this market again to beat the competition that we're currently in. So I think I would say those three major factors that we would consider as a company if we decide to move forward and bring outside investor to our company.
Yeah, very, very good. Karl, would you agree with that as sort of the things that a founders would be looking for in a strategic in an investment?
Well, I can understand in Alex's specific position because it's very similar to the position that I was in 2004, 2005. And in this industry, the services business, which Alex and many other players in Ukraine and Belarus and Russia, etc., are in, then the real problem, believe it or not, is it's not salespeople. It's talent acquisition. So, give me 10 good talent acquisition over 10 good salespeople easily. We've got clients knocking at the door we say no to. If we had more people, then it might hire one more salesperson. So mergers and acquisitions is a great way to get scale. And of course, the biggest contracts with the best work with the most exciting challenges to keep very picky engineers happy come from the biggest clients, and the biggest clients want to see credibility, longevity, transparency, governance, and compliance. A lot of those things can be addressed with board members who've appropriate experience. For example, Siguler and Guff, Shaun, I knew Shaun when he was only a young lad, when I was not so young, but he was even younger. And they brought to EPAM, I would say, nothing to do with the day-to-day business, but their board presence was critical to us achieving the compliance and governance necessary to going public, which is very, very different than what you need to be a private company. It's got nothing to do with selling and supplying resources. So, yeah, I would say so. I would say this is very important for you to achieve status at the top level if you really want to grow, because M&A is an important thing these days. There is a very, very large trend towards consolidation. Now, if I was in products and platforms business, I would probably see it differently, because to bring to market in the fastest way the most competitive product with the best feature benefit ratios to win end users, or B2B or B2C, or whatever it is your actual platform is doing, speed is critical. So if you want to develop a product on a budget and try to do it from more natural cash flow, it takes longer. The last to market never wins. So it's far more important to raise capital for people outside of Alex and I's industry who are developing product and platform, but you need a lot more of it, and there's a bigger risk that you'll fail. So,
point on the raising of the money, the entrepreneur needs to know how much money they want to raise and what it's going to be used for. And we've touched on some examples of that with M&A, for example, acquiring other businesses. But in the investment world, this is called a use of funds. Shaun, could you outline from an investor's perspective what you want to see from a founder who presents a use of funds?
Yeah, look, it's a great question. I'd say in the investment business, no investor's in the business of doling out capital without knowing what the uses of capital are. And a really good founder is judged by their ability to make capital allocation decisions well. So oftentimes when we're negotiating term sheets or even presenting a first term sheet, the most obvious question is, why is this round being raised? How dilutive is it for the existing cap table? And what are the use of proceeds? And I think Karl touched upon one, and sort of Alex, which is M&A. But oftentimes, depending on the stage of the business, right? If these are businesses that are hyperscaling and they're on a product side, the use of proceeds could be customer acquisition costs, scaling up the dev team to improve the tech stack, building sort of internal functionalities to improve the scale or the go-to-market readiness of a platform. So, I would say there's use cases that help a business scale. There's obviously working capital, so just cash needed to continue funding your everyday operating expenses of the business, which we expect to see in every term sheet. And then oftentimes we'll have transactions occur when a founder or management team comes to us and says, look, we're a business that grows at X percentage. There's a consolidation trend in the industry, and there's a player they'll give us parameters around the size of the business. And in order for us to hit a growth target or growth metric, or to move up in the stack and become a market leader, we need to be more acquisitive and sort of pursue an acquisition, right? And we've seen that happen more often than not in industries where there's a sort of winner take all dynamic, and we're interested in backing a player that has the ability to sort of gain a market leading position in terms of market share. So that's always a favorable thesis to see. Instances where we apply more scrutiny is when founders have more generic uses of capital, like working capital uses, or cashing out former shareholders. We're pretty averse to doing secondary transactions. We like our capital to be primarily invested in the business. But yeah, there's a lot of scrutiny that happens around the way the founder or the management team sort of outlines their uses of capital and their capital allocation decisions.
We've been quite lucky because we've received some questions in advance from the audience tonight. There are some good questions and there are some more naive questions, which is great because it gives us an indication of where everybody's at. But one of the questions that we received was, after raising a round, what would a startup company use the money for? And I think we've answered this now, that actually, as a founder, your job is to go into the raise knowing how much you want to raise and what you want to use it for, if you want to be successful. So, Karl, as someone who has received funding and has had people, as you mentioned with Siguler, Guff, sit on the board and help as an investor, what was your opinion of institutional investors before and during that process? Do you think that it changed at all, or do you think that it was quite transparent?
It's obviously very transparent. I mean, it's not very complicated. They're very wealthy. They have money. I need it. We take it. They take a risk, and they want a big profit. At the end of the day, that's the essence of the entire industry, and so you have to deliver it. Which goes back to your last point. Anybody who doesn't know what they need to do with money before they're raising it is probably not going to raise it unless there's some quite weak investors. But I felt that they did exactly what I thought they would do, and I felt that they didn't do what some people believe they do, which I didn't think they would do. They didn't run the business for us. They gave us guidance when asked, but they really helped us. There is multiple parts to a business. There's the selling side, there's delivering a product or a service, but there's building an infrastructure that can financially and in terms of compliance, accounts, allow the management team to grow significantly without rate. We only raised 2 rounds over 20 years prior to, I think we only raised two rounds really, a pre-IPO round and a round time before that. The reason we got to the size that we did was we took a long-term bet early on building a public company. And of course, if you've never been an executive or a board member of a public company, that's a bit of a black box. Private equity can bring some people to the table who know how it happens in bigger, more mature, more compliant companies, and that's really the best help. If you're looking for them to sort out your problem, if you think you're struggling with sales or struggling with engineering, really sort that problem out yourselves, because you don't expect venture capital, private equity to sort that out. I've heard people who think that, we're going to get smart money. It's smart legally, it's smart financially, it's smart in financial compliance governance. It's not smart in software engineering or sales in a major sense. So it's not a cure-all, it's not a magic wand, it has a purpose. And it's a banks plus, and you need to be able to run your business. At the end of the day, it's like having a bunch of older uncles or sort of relatives who know what they're doing and have done it before, who will help you, but they're not going to do your job.
Yeah, I think that's a really good point, and I think as well, a smart non-executive director in your business, if you're private, you'll reap great rewards from that, but that also doesn't necessarily have to come with investment. There are lots of people who would make great non-executive directors who may don't come with institutional money attached. So I think as a founder you can pick and choose without feeling it has to come attached with a large raise. One of the questions
the good point is that private equity will make sure that happens. That's a part of their terms of investing, rightfully so. They will want to see proper board governance. And of course, people should understand. I found it quite interesting, the number of people I've spoken to as entrepreneurs or spoken to doing due diligence working for private equity companies, assessing the entrepreneurs, that people haven't fully absorbed the difference between an independent non-executive director and a non-exec from a private equity investor. They're not independent, and their job is sort of apparently more clear in terms of what their primary goal to protect is. So you can have I'm an independent director on Ajax. I'm not involved in any shareholding, either from the founder or from the private equity involved. My job is to be an independent director and advise them on compliance and governance with nobody's particular interests at mind. And we have in EPAM and other companies of our size have several independent directors. So there is independent, not just non-exec directors that you can use. So you do get a 2-for-1 with the money, though. You get that anyway because they need to do that to make sure that you do the best you can.
Yeah, no, that's very well said. One of the other questions that came through in advance is how to maximize your valuation. Again, a little bit of benefit of the doubt on that one. And I'm sure every founder wants a big valuation. But Shaun, probably another one for you. How is a valuation derived and why is it important?
Yeah, sure. It's a great question. So valuation is derived based on traditional valuation metrics. So just in a very crude manner, if you want to maximize valuation, maximize your earnings. So I'd say those two are very highly correlated. Depending on the sector, and Karl can lend some credence to services. When you're looking at services businesses, these businesses tend to have pretty steady gross margins, attractive EBITDA margins, and usually evaluations derived on the basis of your EBITDA margin by way of a multiple. If you're looking at product-based businesses in today's day, given the size of rounds that are being raised and the size of problems being tackled by these products and these businesses, valuation multiples are now done on the basis of sales. They can be on gross margin. So, my point is, if you'd like a large valuation, you obviously have to have the numbers to back it up and the earnings to back it up. But I'd caution, a lot of founders always want to maximize for valuation. The challenge with raising a large valuation at an early round, and maybe you convince an investor to give you the valuation you want, is, as your business scales, if your valuation is ahead of your earnings base, there's a risk that if your earnings don't perform in the future, your valuation gets compressed. And when that happens, the founder's equity, or the total equity capital of the business, gets diluted down as new equity is invested at a lower valuation. So there's a very interesting relationship between where you raise your valuation, the sort of the level or the absolute quantum, and the percentage dilution that a founder takes as a result of that valuation. So hopefully that was helpful.
Yeah, no, absolutely. And obviously, the valuation, the amount of money that you're raising, the valuation forms really the framework of the term sheet, which for when an investor has found a business they want to invest in, the term sheet is how they deliver that message, I guess, in a kind of a formal way.
Right.
And within that term sheet, there'll be other terms as well between the founders and the investors. So as we kind of get into the deal, let's talk a little bit about the term sheet and what that signals and the relationship between the investor and the founder through that. Karl, I guess you've probably had a lot of experience with this in the 2 rounds that you've done that you mentioned. What does that process feel like when you're on it from the founder's perspective? You might be muted, Karl, or you.
So since I retired and I wasn't raising money as I did with EPAM, I've been working on the other side of the table, which is advising people investing. So, and I participated in the courtship, dancing, dating, and eventual marriages that happen in that game. And so I would say there's a number of interesting dynamics. And of course, the key is all advice like this changes on the industry segment specifically you're in. You can't say IT, you've got to say IT services, products, this type, that. So there's no sort of general advice fits all. But I would say that the people who've generally had the most successful terms and conditions and who've got the best valuations have quite often done something which I really don't like personally, but it seems to work. They've hired sell-side brokers. So they've hired firms like GP Bullhound, for example, which is a famous one, who advise smaller companies how to sell to bigger companies or how to cause a beauty show between strategic acquisitions and private equities. Because like anything else, Alex at Innovecs and EPAM, because we're in a market where demand outstrips supply, to some extent, we're in a very strong negotiating position with clients. If that were not the case, as it was in 2003, 4, and 5, when I had to beg, scream, and like kidnap people to visit like Minsk or Kiev, it's like, oh my God, what's going to happen to me? Will I get kidnapped? Will someone murder me? Should I bring my own? I actually had a guy, a CTO of a company in America, ask me if he should bring his own toilet paper when he was coming on the business trip. Now it's different. So if you've got strategic acquisitions who are competing with private equity or multiple private equity, there's nothing like competition to drive up your valuations. And there are advisors who are very good at playing this game. It is a process. It is an industry in and of itself. And so sometimes you think, oh, why should I give 2 or 3% to these people? If you give 3% to someone and they get you a 30% better result, I think you can do the maths yourself. So I would advise sometimes that, paying these sell-side brokers, which when I'm on the board of EPAM and we're looking at acquiring, I hate them because they spend their entire life, what I say, putting lipstick and Christian Louboutin shoes on the pig, right? And, you end up buying a pig with high heels and lipstick. But, for somebody raising money, professional advisors is maybe not a bad thing, or stimulate and strategically plan a competition when you've got more, when you've got more than one, you can afford to be a little bit more demanding. That would be what I would take away from my lessons of 20 odd years if I wanted to raise money again.
Yeah, and I'm sure great business fundamentals as well. You need to have a great business that people want to acquire or want to invest in to start with. But I'm sure everyone's picking up the phone to GP Bullhound now after that recommendation from you, Karl. So, one of the other questions that we had online was about the diligence process for an angel investor, a VC investor, or a private equity firm. And obviously, I think one of the other interesting points about that question is that it's different stages of a life cycle as well. Alex, quick question for you: did you, when you started your business, found your business, did you do a friends and family round, or have any angel investors come and help you, or was it bootstrap? What was your journey at the beginning of Innovecs? You are muted as well, Alex.
I'm back. Yeah, when we started Innovecs, it was mainly, I would say, like a friends type of money in, because I don't think we really expect that we're gonna build something big. It was basically something that we can try to bring that money in and build a company, and so that's how we started. Today, as I mentioned before, we're at the stage where if we have to make a decision, if we want to go to that Premier League, right, we have to reshape the company. We have to reshape the management of the company. We have to reshape also the shareholders of the company to really get to the Premier League and be able to face new clients, new challenges, and new opportunities. So for us, the journey that we're currently in, when we talk to different private equity or VC, is really to also to make a decision for ourselves if we're actually ready. Because once we go to that journey, I think me as a founder of the company, or CEO of the company, and my management team, we have to really understand if that's something we actually ready for. Because based on my maybe previous experience in the previous company, before raising, after raising, it's kind of two different lives. And for us right now, that's what we're trying to consider. And again, if we want to grow, we want to scale, if we want to win this competition that we're currently in, then we believe we need to raise that smart money and be able to go in a little bit different direction, a little bit more strategic direction of how we're going to win that market over, by not basically going hiring people, but mainly go and build, I would say, we call it two major products. One product for us is the center of expertise, to really verify what exactly we're going to sell, what kind of expertise. And the second product for us, people, how we're going to engage people, how we're going to retain people. And again, one of the option today, we believe, is the M&A option, to really go and buy a company that has those people, has the talent, has the expertise, and move faster than our competition.
Yeah, and just on the point of diligence, I can imagine when you took that first money into the company, that friends and family money, they didn't do too much diligence on
No, I think it was
combing through everything.
It was like any business, right? We just sat together and said, you know what? Well, we're just gonna build something similar to other company we've seen on the market. That was it, right? It was no any evaluation, was no any assumption. It was basically something that we can just try, and if it's gonna work out, and it did work out, and once it was gonna work out, then it's a different game.
Great. And so, Shaun, I guess taking that on, then we've got friends, family, angels. Once you get into the VC, institutional money, and PE, obviously, I hope they do a bit more diligence than Alex's friends did on his business at the beginning.
Yeah, no. So I'd actually delineate it even further. I think VC diligence is way lighter than private equity diligence, just given how the maturity of businesses change a lot from VC stage to private equity. I'd say the big difference on the VC side is you're much more focused around understanding what the scalability or potential scalability of the business is, which requires a lot of market sizing and sort of market sizing data and sort of assumptions. And then the second is, potential unit economics, right? So I talk about gross margins with services being positive, but many businesses, when they're raising their Series A or their Series B, don't have positive gross margins or have negative, EBITDA margins, and they're still in a process where they're prioritizing scale over profitability, which is fine. So you can't use a traditional private equity diligence playbook to diligence venture capital opportunities. You have to think about what are projected or what are estimated unit economics when the business is fully mature. The last is, and I come back to this time and time again, when investing in a private equity private equity stage business, you usually have some maturity in earnings, and the management teams are fairly seasoned. So it's not one gentleman running the business; they've hired a stable of individuals, and the company is fairly mature from an employee headcount perspective. When you're looking at venture, it's usually betting on a founder with a very prolific idea and understanding that the business will pivot a few times before they find product market fit or founder market fit. So just thinking about diligence streams, it's very different for private equity. Our focus is much more around cash flow, quality of business, and a lot of time understanding the quality of the earnings, go-to-market strategies. We do reference calls with customers. And the focus is really making sure we're buying a good asset for the right price. When we look at earlier stage businesses, it's much more understand the founder's marketability, how scalable the industry is, what the total market size is, and then does the founder, the management team, have the ability to raise successive rounds? So founder marketability is really important. Is this founder going to be able to raise a Series B or Series C? Or am I running the risk of being the one round of capital that goes into the company with the unfortunate possibility that they may run out of capital if the founder is unable to raise more money?
Yeah, no, great answer. And one of the other questions that we received online was about how do business, and this may be a myth or not, it may be to do with private equity and not VC, so would love everybody's opinion here, but how do businesses raise money without losing control? And so I think as a founder, there's probably a fear that you're going to lose control of your business. Karl, what's your opinion on that?
Well, I think it's a bit of an odd question because there's a simple answer to it: it's raise less and don't lose control. You can't have it both ways. You can't have control and access to large amounts of capital unless you have an extremely attractive, extremely unique business with very strong growth and very strong profit. It's absolutely not even university level. I'd say we call in England sort of sixth form boys grammar school level of economics. The more attractive you are, i.e. you have a unique, cool, super upcoming space, or you're in a boring old one, you have a fast growth or you don't, and you have profits or you don't, all of those will dictate how attractive you are. And the less attractive you are, the more you give up. But you can't beat that system. So I think it's pointless worrying about that question. If you need, I would say a very good piece of advice, if you don't need money, don't raise it. right? And it goes back to Shaun's first comment and what seems to be patently obvious. Why would private equity invest in companies that don't have a good use of proceeds plan on the table? Going back to the question of, if we raise money, what should we do with it? I think those are chicken and egg questions, and I would say that would indicate the founders are not really ideally running a good business. So I think the question, if you think about it, answers itself, which is you can't raise a lot of money and keep control unless you've got an amazingly successful business with huge growth and huge EBITDA.
Yeah, I think that's a very good answer. So we've talked a little bit. We've talked now about sort of a little bit about raising money. We've talked about going through the process. How does that relationship evolve once you have taken investment or taken the money? Karl, you talked yesterday when we were chatting about the strength of running a good board or governance. Really, from your perspective, that's the biggest strength that someone can bring after you've raised money?
Well, the biggest strength is the money, and of course, whether or not that strength is wasted, depends on the question we've just discussed several times between Shaun, myself, and Alex, which is the use of proceeds. So if you don't use it wisely, it won't have much of an impact. But yeah, I think that the best thing that they bring is a need to focus. They take the optionality of self-motivation and self-discipline away and force it on you. And they will help you to solve things in days that might take you many months otherwise. That's effectively it, really. Private equity is better. Venture capital will invest in massive number of companies, fully expecting some of them, and quite a lot of them, just to totally tank and disappear. And they don't care if they get 30, 40% that do well. But it's like, it's a different casino game, right? Private equity puts a lot of money and a lot of effort into a fewer number, and it's much more necessary for Shaun to have a better batting average, to put it in baseball terms, than it is for a venture capital company. They can be batting below the Mendoza line and still be happy.
Yeah, well, the average in venture capital is... Sorry, go ahead, Shaun.
No, I was going to actually address the question from a different lens. So, when we talk about investing and sort of post-investment responsibilities, I think it's, if any private equity investor told you that they had perfect information and 100% clarity for business before investing and were not at all surprised after investing, they'd be lying to you. I think generally, no matter how much diligence you do, once you join the board, you actually start seeing board materials, and you're really in the business with the management team. It really, the sort of word that comes back to me is trust, right? You have to have, if the founder is operating with integrity and they're open kimono about sort of where the sort of bodies are buried, if you may, and open up to the private equity funds or the sponsor about, what are the 3 or 4 key issues that have to be addressed. It is our responsibility then to make sure that we set KPIs. We sort of, as Karl says, force you to eat your salad, and really, we put a sort of regimented plan in place to make sure those KPIs are met. And depending on the amount of work that's needed, the check-ins are sort of set accordingly. So my day-to-day job today, I have 10 portfolio companies. I know which portfolio companies need a quarterly check-in, where the management team is completely in control, drives the business, and the information is very much pushed out to us versus us pulling. And there's somewhere where I'm on the board and we're required to check in more frequently because there's a real business problem at hand, and we're viewed as a long-term partner to the management team. I think where the relationship really gets to go sour, and Spike, this answers the earlier question you had, is if the trust really breaks down and there's an inability to for the management team to trust the sponsor and the sponsor to trust the management team, and that's really how you can get into situations where either the management team loses control or the private equity sponsor decides that there's a path which requires hostility versus long-term commitment to partnership.
It sounds very strongly like when you talk about trust, that this is a relationship between the investor and the founder that is going to last a while. It isn't just about here, write a check, off you go. That there's a relationship through that right to the end. That
Right.
sounds right too. And
Yeah,
Shaun,
absolutely.
could you quickly just...
Sorry, I was just
Sorry,
going to
the
say,
connection.
we've had instances where a management team will give us a budget prior to investing, and we'll scrub that budget, go back to them a few times, and we agree on numbers before making the investment, right? And usually a check-in post investment, and once we have sort of a roadmap for where the business is trending, is really helpful. And then the onus is on us to make sure the communication lines are open, so that the management team can sort of echo to us if anything is changing and business plans are going off piste. What we really hate to see is we show up at a board meeting and find out you missed budget by 50%, and there was no indication of that prior to to getting to the board meeting.
Yeah, you want a bit of a heads up on that before it comes to the board meeting.
Of course.
Just
Yep.
While we're talking technical, we talk a lot about boards. Can you quickly break down the difference between a board observer and a non-executive director on a board, or a board director, and what a founder should think about when he is giving away, board positions in his business?
Yeah, sure. Karl, do you want to lend your perspective from the EPAM public board experience, or would you like me to go first?
Oh yeah, I mean, also, yeah, I would say it's not just EPAM. I think board experience. I'm on three other boards as well. Pretty standard. Sure. Board observers basically participate in the board, but they don't have a vote. Independent board directors are necessary primarily when you have a target to become listed in a public equities market where the number of independent, and by the way, independent, you would be amazed at how many people believe what independent means. It means truly independent. It doesn't mean that you only have 10% or 5%. So there is an independent board member's job and a board advisor's job. Board observers are typically a compromise between entrepreneurs who are afraid of losing control and private equity companies who are afraid of not having any control in case there's something wrong. Private equity actually really don't want to get involved. They would just love to give you money and get loads of it back, but they've found in reality they have to help you and keep an eye on things, right? It's not a power game. So board observers allows them to bring in different people with different skills to board meetings to keep for example, I have a predominantly sales and marketing background, although I was in the technology side for a part of my career. And some people might want a board member with that skill, and the other official board member is more of an oddity. So it allows the private equity to have more brains and more eyes on the game without taking away the number of voting board seats. But at the end of the day, really, your shareholders' agreement and your investors' agreement isn't just about the number of heads on a board. It's about what preferences and what limits and things are. So that the issue of giving up control is sort of misunderstood. And board observers just don't vote. And I think independent directors are something you need if you're trying to go really ultimately public. If you're not planning to go public, independent directors may not even be necessary.
Okay, very good. We're into the last sort of 5 or 10 minutes of the discussion. So if people who are watching on YouTube would like to ask some questions, please put them in the chat now. I'm going to ask another question here, and I apologize a little bit for it, but because it's COVID related, and I think we're all trying to forget about COVID and move on. Karl, I know you just landed in Italy, but the funding market, because of COVID, what do you think CEOs need to know now because of the pandemic, or do you think there's been any changes to the investment market? Shaun?
Yeah, it's a great question. I think from a funding perspective, our business model has remained relatively unchanged. But the challenge is, we're looking for businesses now that have the agility and the ability to survive in stressed environments. And what COVID has sort of taught us is, when you're faced with this, exogenous shock factor to the global macroeconomy, businesses that are unable to pivot and find agility are the ones that are bound to be in the long term sort of the losers or non-survivors. So I think where we have really placed emphasis and where we think value lies in our portfolio is those management teams that even if they have a business model that is being disrupted by COVID, have managed to be proactive in reallocating capital, in sort of restructuring the way their or sales force or employee workforce is sort of staffed, and has found ways and avenues to continue to survive despite a massive glut in demand. Right. So again, I come back to my first point, and this is first principles. How good is the management team at surviving stress situations? And as we've noticed, the best management teams are the ones that were able to get through COVID with, business models may have been scathed, but they survived with a lot of resilience.
Alex, how have you found it as a CEO, sort of coming out of the pandemic and the changes to your business?
Sorry, I put on mute all the time. I think from our side, I would say we went through this pandemic, I would say, in a good way. We didn't really see a lot of impact on our revenue growth or on our profitability, mainly for not because we were like smarter than anyone else. Probably just were in an industry that actually picked up because of the pandemic. For example, we're talking about like logistics or healthcare. Or fintech, right? Those actually the verticals that actually start to boom because of the pandemic, so compared with other industry. So I think from our perspective, we haven't really received any impact on the growth. The only thing probably what we see right now, one of the, let's say, the challenge, I won't call issue, but the challenges because of the pandemic create this new way of working model, which we call remote. And in some cases, say that works very well for some company, but also creates some kind of a bottleneck for potential scale up when it comes to the hiring process. But overall, from the company perspective, from the market and verticals that we're focusing on, we haven't seen a lot of, it was some impact maybe in Q1 or Q2 of the last year, but currently we see like big demand. And as Karl mentioned before, the question is not about getting like a new client. The question is about actually to find the talent to serve the client. So then that's what we're actually facing the challenge right now.
Understood. And as we come now to the end, I was wondering if each of you would like to share a little piece of advice for a founder who was thinking about raising money. If you were to give sort of a piece of advice to them, other than pick up the phone to GP Bullhound, it would be great to know what that would be and what we'd ask. So I don't know, I've picked on you a lot, Shaun, but if you could go first, I'd be very grateful. Then we'll go to Karl, and then we'll finish with you, Alex.
Sure. I'll keep mine short and sweet. We've said it a few times, but know your business inside and out, and know your reasons for wanting to raise a round. I think we've heard from, and we have anecdotes of instances where founders think it makes sense to raise capital just as a signal to the market. But I think, again, being a good allocator of capital is important. So understand why you want to raise, understand your use of proceeds, so what you're going to do with the money, and then pick your partners carefully. It's important to take time to understand who you're going to let into your business. If you built your business, sort of bootstrapped it and put your effort and time into scaling it, the strength of the relationship is everything because it's built on the back of trust. So pick your partner wisely, and if you're building a solid business, the valuation will follow. So if that's the first parameter you're looking at, I think focus on building a solid platform.
Yeah, that's great advice. Thank you. And Karl, what advice would you give to someone who was looking to raise money?
Well, I would say listen to Shaun for the first point because he just said most of it. As for GP Bullhound, by the way, that's one of many. I did say that you can find plenty more. Private equity will not rescue a mediocre business model, and it won't make a bad business model good. Today, however, we are in a fortunate business where, as a consultant who gets paid by private equity and venture capital to look at companies they've sort of said that they want to invest in, and then they say, Karl, we want you to do interviews, assessments, really poke into the P&L, the sales, all the sorts of delivery, and we want you to do a destructive testing. And I can come back with very solid, no, don't invest. It's not that great. It's not exciting. It's not good. It's not exceptional. It doesn't stand out. And they go, yeah, we agree, but we're going to invest anyway. There is, going back to Shaun's comment at the lot, there's never been so much money looking for investment. So it's quite easy to get money, but really don't do it unless you have to. Don't think that it's better to have it than not have it, and don't really have a sure. Have a really sure plan what you want to do, and make sure your business is doing well. Otherwise, you're just diluting yourself for you're taking out of your piggy bank today what you could take out later for more.
Yeah, no, fantastic advice. Alex, anything? I know you're on your journey of discovery with raising, but anything to add?
No, I think from our side, I would say once you make the decision to give out the equity and raise the money, I think you need to really understand how you're going to spend that money for. So it's not going to be only dilution for you. Will be actually so your remaining equity will actually be multiplied if you know exactly how you're going to spend the money that you raise. That's number one. Number two, I would say once you make the decision to raise the money, I think it's very important that you as the founder of the company, as well as your management team, is actually ready to pick up that scale and be ready to scale up the business. Now being with the potential, I would say, investor or people that will be sitting on your board and probably provide more aggressive strategy to move, to grow the business. So I would say those two major things. One is the raising once you know how you're going to spend it. The second thing, make sure your company, mainly your management team, is actually ready mentally, right, and experience-wise to drive that business with this new money coming in.
Very good. Well, I hope that's been insightful for those who are watching along. Alex, Shaun, and Karl, thank you very much for all your insight on the subject of raising money. And thank you very much.
Thank you.
Thank you, guys. Thank you all. Thank you. Bye-bye.
Thank you all.
Thank you, everybody. Bye-bye.
Thank you.